Profit planning is an important management function for any business. Profit of any business firm depends on many factors like selling price, volume of sales, variable cost per unit, total fixed cost, sales mix, etc. A detailed analysis of behavior of cost and profit as a function of expected sales volume is very important for efficient decision making. CVP analysis helps the management in predicting how the profits of the firm will be affected by changes in any of these factors and thus helps in decision making. CVP analysis helps in answering the questions such as what will be the impact on profits of the firm if there is a change in selling price or sales volume or fixed cost or sales mix, etc. This technique is very useful in decision making such as fixing the selling price, finding the desired or target level of sales to achieve some given target profit, selecting the product mix, choosing among the alternatives, marketing strategies, and analyzing the effect of increase or decrease in cost on the profit of the business firm.
After studying this module, we shall be able to learn the meaning and concept of CVP analysis, that is, the cost volume profit analysis, understand the techniques of CVP analysis, know the contribution margin concept, evaluate the contribution margin ratio or PV ratio and its uses, identify factors influencing PV ratio and the concept of contribution margin, and limitations of CVP analysis.
CVP analysis is an important management accounting technique that analyzes the effect of changes in level of output on costs, revenues, and profits of the firm. CVP analysis is based on the theory of cost behavior, that is, how do the costs respond to changes in the level of output. It studies the relationship between change in volume of output and changes in selling price and cost on the profit of the firm. Profit planning is an important management function for any business. Profit of any business firm depends on many factors like selling price, volume of sales, variable cost per unit, total fixed cost, sales mix, etc. A detailed analysis of behavior of cost and profit as a function of expected sales volume is very important for efficient decision making. CVP analysis helps the management in predicting how the profits of the firm will be affected by changes in any of these factors and thus helps in decision making. Three factors, namely cost, volume, and profit, are interrelated, and one's behavior with respect to the other two factors has to be analyzed in details for determining the profitability of the firm. CVP analysis helps in answering the questions such as what will be the impact on profits of the firm if there is a change in selling price or sales volume or fixed cost or sales mix, etc. This technique is very useful in decision making such as fixing the selling price, finding the desired or target level of sales to achieve some given target profit, selecting the product mix, choosing among alternative marketing strategies, and analyzing the effect of increase or decrease in cost on the profits of the business firm.
CVP analysis is based on certain important assumptions, and if these assumptions are not taken care of, serious errors may occur and consequently decisions taken may be incorrect. These assumptions are: number 1, except volume, that is level of output, all other variables like selling price per unit, variable unit cost, and total fixed cost remain constant. Number 2, costs can be accurately divided into fixed and variable components, and there is no concept of semi-fixed cost. Number 3, it is assumed that the sales mix remains unchanged, implying that either the firm is producing a single product or the product mix remains constant. Number 4. Profits are calculated on the principle of variable costing, wherein fixed costs incurred during the period are treated as period cost and hence charged to the sales of that period only. Number 5. The efficiency level of production is assumed to remain constant, that is, there is no productivity gain or loss. Lastly, it also assumes that total fixed costs remain constant over the entire range of activity being considered. There are two basic techniques of CVP analysis: one, contribution margin analysis, and two, break-even analysis. Contribution margin analysis. Contribution margin indicates the profit potential of a business firm. Contribution margin is the excess of sales revenue over variable cost. From contribution margin, when fixed cost is deducted, the resultant figure gives the amount of profit or loss to the business firm. Thus, contribution margin is used to cover fixed cost, and once the fixed costs are recovered, any remaining contribution margin adds directly to the profit or loss of the firm. It is most commonly used technique for planning and decision making. Symbolically, contribution margin, that is CM, is equal to selling price minus variable cost. As selling price per unit and variable cost per unit are assumed to be constant, the contribution margin per unit also remains constant. The term contribution margin is different from the term gross profit. Contribution margin is the excess of sales over variable cost, whereas gross profit is the excess of sales over cost of goods sold. Unit contribution margin or contribution margin on per unit basis also indicates the profit potential of a product or activity. The unit contribution margin is the money available from the sale of each unit to cover fixed costs and to provide profits to the business firm. For example, if the selling price of a company's product is rupees 100 and variable cost per unit is rupees 60, then the unit contribution margin will be rupees 40, which is rupees 100 minus rupees 60. However, if sales are given in total money value, that is, the sales revenue, instead of selling price per unit, then in such a case the contribution margin ratio becomes important. The contribution margin may be expressed in the form of percentage as well. The contribution margin ratio is also known as contribution to sales ratio, that is CS ratio or PV ratio. This ratio denotes the percentage of each sales rupees available to cover the fixed cost and to provide operating income to a firm. Symbolically, contribution margin ratio, that is CM ratio, is equal to selling price minus variable cost whole divided by selling price multiplied by 100, or CM ratio is equal to contribution per unit divided by selling price per unit multiplied by 100, or total CM is equal to total sales revenue multiplied by CM ratio. Also, total contribution margin, that is total CM, is equal to number of units sold multiplied by contribution margin per unit. If the sales volume is expressed in terms of number of units sold, the contribution margin per unit is relevant to find out total contribution margin, whereas if sales volume is given in terms of total money value, then contribution margin ratio is relevant to find out the total contribution margin. For example, if for total sales of 500 units of a product, the selling price per unit of a product is rupees 50 and The variable cost per unit is rupees 30 per unit. In this case, the contribution margin per unit is rupees 20, that is rupees 50 minus rupees 30. That is, each unit sold generates a contribution of rupees 20, which is available to recover fixed cost and to contribute towards the profits of the firm. Here, the contribution margin ratio, also known as CS ratio, will be computed as contribution margin ratio is equal to 50 minus 30 divided by 50, which is selling price, multiplied by 100, which comes out to be 40%, and total contribution margin is equal to rupees 20 multiplied by 500, which is equal to rupees 10,000. And if total sales revenue is given as rupees 25,000, that is 500 units multiplied by rupees 50, which is the selling price, then the total contribution margin is equal to 40% multiplied by 25,000, which comes out to be 10,000. CM ratio is also called PV ratio, that is profit volume ratio. This ratio is being used by the management to analyze the effect of changes in sales volume on profit figure of the business firm. Higher PV ratio indicates high profit due to increase in sales volume, and low PV ratio indicates smaller profits due to increase in sales volume. If a business firm has been able to cover fixed costs, the net income of the firm will increase by unit contribution margin multiplied by additional sales units, that is, the change in sales volume. Special features of PV ratio. The PV ratio helps the management in ascertaining the total amount of contribution for a given volume of sales. It remains constant till there is no change in the selling price and the variable cost per unit, or they fluctuate in the same proportions. It is not affected by the level of activity. It also remains unchanged even if there is a change in fixed costs. The concept of PV ratio can be usefully applied in the following. Number 1. Determination of variable cost for any volume of sales. Number 2. Comparison can be made by calculating the PV ratio for each factor to be compared. The factor may be line of product, sales area, method of sales, for example, sales through wholesaler or through retailers. Number 3, it helps in calculating the break-even point. Number 4, it helps in calculating the profits when margin of safety is given. With the help of PV ratio, profits at the given or desired level of sales can be computed. PV ratio helps in calculating sales when a desired level of profit is given. Calculation of desired volume of output, profit, or other essential factors. Factors influencing PV ratio. Number 1. Selling price. It directly influences the PV ratio. An increase in the selling price directly increases the PV ratio as it increases the contribution margin, assuming per unit variable cost to remain unchanged. Similarly, a decrease in selling price decreases the contribution margin and thus the PV ratio decreases. Number 2. Variable cost. Variable cost per unit affects the PV ratio inversely. An increase in the variable cost decreases the PV ratio as it decreases the contribution margin, assuming per unit selling price to remain unchanged. On the other hand, a decrease in variable cost increases the contribution margin, assuming per unit selling price to remain unchanged, and thus the PV ratio is improved. Let us see what happens in case of simultaneous change in selling price per unit and variable cost per unit. A simultaneous increase in selling price and a decrease in per unit variable cost results in better PV ratio and thus improved profitability of the business firm. A decrease in selling price and an increase in per unit variable cost results in worse PV ratio and thus decrease in profits of the firm. Product mix. A change in the product mix has an impact on the PV ratio for the firm as a whole. If the share of the product with higher PV ratio in total output and sales increases, the overall PV ratio will increase. This can be calculated as total contribution divided by total sales multiplied by 100. For example, let us assume that a firm manufactures and sells a single product with the given information. Selling price per unit is equal to Rs 25, variable cost per unit is equal to Rs 10, total fixed cost is equal to Rs 30,000, contribution sales ratio or PV ratio is equal to contribution margin per unit divided by selling price per unit whole multiplied by 100, which is equal to 25 minus 10 divided by 25 whole multiplied by 100, which comes out to be 60%. If the selling price increases to Rs 40 and the variable cost remains unchanged, the PV ratio will increase to 40 minus 10 whole divided by 40 multiplied by 100 is equal to 75%. If the selling price remains unchanged and the variable cost increases to Rs 15, the PV ratio will decrease to 25 minus 15 whole divided by 25 multiplied by 100, which is equal to 40%.
Break-even analysis. Break-even analysis is a fundamental technique of CVP analysis which indicates at what level costs and revenues are in equilibrium. It is the simplest method of presenting to the management of the firm the effect of changes in volume on the profits. The contribution margin per unit is available for recovery of fixed cost first and then to contribute towards the profits of the firm. Since fixed cost remains constant during a given period, a firm must sell enough units to generate sufficient total contribution margin which is at least equal to the fixed cost. Thus, break-even point is the level of sales at which the contribution margin is just equal to fixed cost and the firm has no profit and no loss. At break-even level, total cost, that is variable cost plus fixed cost, are just covered. Any sales below the break-even level will result in loss and sales above the break-even level will give profits to the firm. It is called break-even point because it gives the level of output which evenly breaks the cost and revenues. That is, the cost and revenues are equal at this point, resulting in no profit nor loss situation.
Symbolically, break-even sales in units is equal to fixed cost divided by contribution margin per unit, or break-even sales in volume is equal to fixed cost divided by contribution margin per unit whole multiplied by selling price per unit, or break-even sales in volume is equal to fixed cost divided by PV ratio. CVP analysis is a very useful technique for business decision making. It can be used to measure the effects of changes in key factors like selling price, sales volume, fixed cost, variable cost, etc. It is also used to measure the effects of alternative management decisions on the profits of the firm. CVP analysis is useful for the decisions on product pricing, sales mix, adding or removing product lines, operating methods, selling policies, etc. Let us discuss some important applications of CVP analysis. Changes in selling price. To analyze the effect of changes in selling price on the potential profits of the firm, the CVP graph is generally used. A CVP graph displays the relationship and changes in costs, volume, that is level of output, selling price, and profits of the firm graphically. Any change in the selling price of a product changes its PV ratio, which in turn has two effects. First, a new break-even point is established, and then profits above and below the break-even sales will be different. If the selling price is increased, it increases the PV ratio as well as the rate of recovery of fixed cost. Thus, break-even point declines, the profits beyond the break-even point increases, and loss below the break-even point decreases. On the other hand, if the selling price is decreased, it decreases the PV ratio and the rate of recovery of fixed cost declines. Thus, the break-even point moves to a higher level, profits beyond the break-even point decreases, and losses below the break-even point increases. Changes in variable cost. The CVP chart is also used to evaluate the impact of increases and decreases in variable costs per unit. Changes in variable cost changes the PV ratio, changes the break-even point, and affect profit and loss at different volumes. The effects of changes in variable cost can be summarized as: an increase in variable cost has the same effect as a decrease in selling price. It decreases the PV ratio and the rate of fixed cost recovery is lower. The break-even point moves to a higher level. The profits after the break-even point decreases, losses before the break-even point increases. Let us see the impact of decrease in variable cost. A decrease in variable cost has the same effect as an increase in the selling price. A higher PV ratio is achieved and the rate of fixed cost recovery is increased. The break-even point declines, profits beyond the break-even point are higher, and losses before the break-even point are lower. Changes in fixed cost. Increase or decrease in fixed cost does not have any impact on PV ratio, but they change the break-even point. With the same PV ratio, the rate of fixed cost recovery remains the same. If fixed costs are increased, the break-even point in the terms of break-even volume is higher. Profits above the break-even point are lower by the amount of increase in fixed cost, and below the break-even point losses increase by the amount of increase in fixed cost. If fixed costs are decreased, it lowers the break-even point. The profits are greater by the amount of decrease, and the losses are smaller by the amount of decrease in fixed cost.
Desired or target profit. Sometimes the management faces two decisions: one, to increase the sales volume through reduction in selling price, and two, to increase the selling price in case the PV ratio is low with the expectation that a higher profit will be earned. These decisions should be taken carefully after studying the profit pattern and other factors, otherwise the results can be harmful, particularly for those companies whose PV ratio is already low. Also, if reduction in the selling price does not increase the sales volume, the price reduction will result only in lower profits. Price cuts like increase in variable unit cost decrease the contribution margin. On a unit basis, the price decreases may appear to be insignificant, but then the unit differential is multiplied by thousands of units, the total effect may be significant. Perhaps many more units will have to be sold to make up the loss in profit or to earn a target profit.
Multi-product situations. When there are multiple products with different contribution margins, the mix of the product has a direct effect on the fixed cost recovery and the total profits of the firm. Different products have different PV ratios because of different selling prices and variable costs. Some products make larger contribution to fixed cost recovery and profits than others. The total profits depend to some extent upon the proportions in which the products are sold. Other things being equal, the sale of the product with higher PV ratio is more profitable than that of the product with low PV ratio, despite the fact that the selling price of the product with low PV ratio is higher than the price of the product with high PV ratio. Sales mix and break-even point. Sales mix is the relative proportion of each product line to the total sales of various products sold by an enterprise. If there are no constraints or limitations, management should try to maximize the sales of the product or products with higher PV ratio. However, a sales mix results because there are limits to the quantities of any given product that can be produced, and there may also be certain market limitations on how much can be sold. When different products have their own different production facilities, selling prices, variable cost, and fixed cost separately, the cost volume profit analysis can be done for each product separately. But in many situations, this is not found, and different products share common facilities and have common fixed cost. In such situations, CVP analysis is performed by averaging the data using the sales mix as weights. Desired profit and tax. The amount of desired profit before income taxes is treated as if it were additional fixed cost in finding out the sales units or sales revenue required to give the amount of desired profit. The usual formula for desired sales is desired sales in units is equal to fixed cost plus profit before taxes whole divided by contribution margin per unit. Also, desired sales in volume is equal to fixed cost plus profit before taxes whole divided by PV ratio. The amount of desired profit can be mentioned as a profit after income taxes. In such a case, the profit before taxes is calculated by the formula which is given as profit before taxes is equal to profit after taxes divided by 1 minus tax rate.
Limited resources. In a multi-product situation, product mix decisions cannot be made in terms of contribution margin only when some resources or factors of production are found to be limited. Such situations are generally observed in business enterprises. In this case, the management should try to achieve the best contribution margin per unit of the scarce or limited factor. The scarce factors are likely to be labor hours, machine hours, space used for production, etc. If there are no constraints or marketing limitations, products having the largest contribution margin per unit of limiting factor should be manufactured.
In spite of its usefulness to the management in decision making, the CVP analysis suffers from some serious limitations, which are: number 1, CVP analysis is an approximation technique. It requires estimates during analysis, and thus it puts a question mark on the accuracy. Number 2, it assumes that total cost and total sales are linear and represented by straight lines, but in actual practice it may not be true. If a firm produces and sells more units, the variable cost per unit may decrease due to high operating efficiency. Number 3, CVP analysis assumes that costs can be perfectly classified into fixed and variable units, but sometimes it is not possible in actual practice. Number 4, CVP analysis assumes that the productive efficiency remains constant, which may not hold true. Number 5, CVP analysis assumes no change in inventory level during the period. That is, units produced during the period are equal to units sold, which may not hold true sometimes in real practice.
Let us now quickly recapitulate what we have learnt in this module. CVP analysis is a systematic method of examining the relationship between cost, selling price, volume of output and profits of the firm. CVP analysis helps in managerial decision making like make or buy, continue or shut down, determining the optimal product mix or sales mix, etc. Contribution margin and break-even analysis are two important techniques of CVP analysis. Contribution margin is the difference between the selling price and the variable cost, and it gives the margins to recover the fixed cost. Break-even level is the level of output at which the firm is able to cover only the total cost and does not make any profit. At this point, total costs are equal to total revenues, and thus the firm is in no profit or no loss position. Contribution margin ratio is also called PV ratio and is computed as contribution divided by sales multiplied by 100. It shows the profitability of the firm. A higher PV ratio shows high profitability and is desirable, and vice versa. Changes in selling price or variable cost may affect the value of PV ratio.